All right. Hi, everyone. My name is Nikita. I am a data science research associate and a PhD candidate at Humboldt University of Berlin, working in a collaboration with a financial institution, Monedo. And today I'm going to talk about credit scoring and about one of the challenges we face in credit scoring, namely the sampling bias. So I will start by describing the sampling bias problem and what are the negative consequences of sampling bias on training and evaluation of machine learning models. And then I will talk a little bit about some of the techniques to correct sampling bias and its adverse effects on training and evaluation. And finally, if I have some time left, I will also speak about further challenges that amplify the sampling bias problem and remain to be solved even after we mitigate the impact of sampling bias. So let me start with the introduction to the problem. Credit scoring setup works as follows. A customer comes in asking for a loan, and we as a financial institution either accept them and give the money or reject them and don't issue the loan. If we accept the customer and issue the loan, after some time, we observe whether an applicant pays back the money, and then we label this applicant as a good risk or doesn't pay back the money, defaults on a loan, and we can then call this such an applicant as bad risk. As time goes by, we accumulate some data on applicants, and then we can use this data to train a scoring model that automates the loan approval decisions and observes the features of the applicants and then predicts the probability of repayment. The problem with this setup is that to train such a model, we need data with known outcomes. And by outcome, I mean whether an applicant actually pays back the money or don't. And the outcomes, the repayment behavior, is only observed for people that we accepted in the past. For rejected applicants, there is no way to know whether they would actually pay back the loan or wouldn't be able to pay back. And because of that, the labels in the training data are not missing at random, which leads to the divergence between training data, which only consists of customers who we accepted in the past, and the target test data that may include all kinds of borrowers from the general population who apply for a new loan with us. And with more iterations of updating the scoring model and training it again, the sampling bias may amplify because of the biased nature of the training data and then translation of this bias to the model and its predictions. Is it bad? Well, we can illustrate that and see what is the impact of the sampling bias. To do that, we use simulation studies. So we generate synthetic data similar to the real data that we have at a financial institution, and then use this dynamic acceptance loop process to see how the sampling bias grows with time. What we observe after running that for a few iterations is that the distribution of the data becomes different. So what you see on this plot here is simply a data distribution density of one of the features of the applicants for different groups of them: accepted, rejected, and population that consists of both potential accepts and rejects. And as you can see on this plot, there is a difference between the green density, which stands for the accepted applicants, and the blue density, which stands here for the population. And as you can see, the peak of that density is observed in the area that is not even observed in the training data of accepts, meaning that we don't even see feature of such values. For example, we don't see applicants with such a low income compared to the applicants that actually apply for a loan. And because of that, our model can make misleading predictions. So let's look at the performance of the scoring model. If we plot the performance with respect to the iteration of the acceptance loop process, here on the vertical axis, we have the performance metric, which is called ABR. This is just simply average bad rate among accepts when we accept top 20% of the customers, and the lower is better. So here we compare a scoring model that is trained on the accepted applicants, a biased model, and a potential oracle model that is trained on the union of accepts and rejects. So this is not available in real life, but since we have simulated data, we know the actual labels of rejects, so we can see what is the upper performance bound and what does it look like. And what you see from this plot is that there is a big gap between the performance of the accepts-based model and an oracle model, which indicates how much performance we actually lose due to the fact that the model trained on accepts is biased. And this difference between these two curves indicates exactly this loss due to bias. So we have a negative effect on performance of a scoring model due to the sampling bias. And this is not where it stops, because apart from the performance of the model and trying to train a better model, we usually do a lot of model validation decisions, right? We can do feature selection, parameter tuning, or maybe we just want to estimate the future performance of the model before we deploy it to production. What will be the bad rate when we implement this model, right? And if we try to do that on a biased validation set that comes from accepts, we also get a misleading estimate of the future performance of the scorecard. The lines here refer to the estimate of performance of exactly the same scorecard, but the green line estimates performance of that scorecard on a validation set from accepts, whereas blue line estimates performance of the same model on a holdout set that is representative. And again, you see a very large gap. If you evaluate on accepts, you can get a very over-optimistic estimate of what the actual performance will be. And this is a problem, because you may underestimate the risk associated with deploying this scorecard, or you may select the wrong scorecard just because it performs better on accepts, but you're not guaranteed that it will also perform better on new applicants that come from the representative sample of the general borrower's population. So this is what sampling bias does. And we would like to fix it. We would like to find a way to correct the training and to correct the evaluation of the scorecard. So how do we do that? Well, there are many techniques out there in the literature, and let me start with the training first. So for the training, roughly we have two groups of techniques that can help us with mitigating the impact of sampling bias. So first of all, you can augment the training data by labeling rejects. So you can just assign labels to rejected applicants, then append them to the training data, which only consists of accepts, and then use this augmented data to train a better scoring model. The simplest techniques could be just, let's assume that all people who we rejected before are bad risks. That doesn't work very well, because usually there are many potential good risks among the rejects. But then we can use some semi-supervised learning techniques to improve on that simple baseline. But another group of methods is about extracting information from rejects without actually labeling them. So trying to somehow use information about the distribution difference to account for this mismatch. And there are many reweighting based techniques that follow this family of methods, where basically the idea is that you can reweigh the loss function of your model while you train it to make sure that you rebalance it towards the applicants that are more likely to appear in the general population of borrowers. This is so-called importance sampling or importance reweighting. I want also to emphasize one other method to extract information from rejects without labeling them, which is using autoencoders to extract features that can be less subject to the sampling bias. So how does it work? We can merge the data on accepts and rejects. We don't have labels of rejects in the real world, but we have features, right? Because we know what kind of applicants were applying for a loan. And we can use this merged data to train an autoencoder to extract some latent features describing our applicants. And these features will be extracted from the complete data set with both accepts and rejects. And in order to motivate the autoencoder to handle the sampling bias, where we can add a custom mismatch penalty in the loss function that accounts for the distribution mismatch and penalizes with the difference in distributions between the accepted applicants and rejected applicants. And in that way, the features we extract from autoencoder would be less subject to sampling bias and might help to improve performance of the scoring model. What we were mainly focusing on in our case is actually labeling the rejects. And for labeling, we started with different semi-supervised learning methods, but the biggest difference between semi-supervised learning and credit scoring is that in semi-supervised learning, it is normally assumed that the labeled and unlabeled data have the same distribution. Here it's different. We know that rejects come from a different distribution region. So the main challenge here is to try to implement different tricks that help to reduce the risk of error propagation and make sure that you don't overfit to the accepted sample and only label a really conservative filtered set of applicants from the rejects in which labels you are most sure of. So we are basically using some variant of pseudo labeling, but implementing different tricks to filter rejects before the labeling and also to early stop the labeling based on some techniques in order to avoid this issue. I will not have time to go into much detail here, but if you have any questions afterwards, I am happy to provide some more intuition on why some of the tricks work. Right. Apart from the training, there is also an evaluation component. The easiest way to fix evaluation is to just evaluate on a representative sample that does not suffer from sampling bias. To get such a sample, what you would need to issue loans to a random set of applicants without any scoring, just give money to the people and observe their repayment behavior. So that way you would be able to get a sample of applicants that is not affected by the decisions of the scoring model and is therefore representative of the target population. But the problem is, of course, is that it is very costly to set up because you need to give loans to people who are usually don't pay them back. And this is why I'm only listing this method here under evaluation, because in order to get such data for training purposes, we would need to give out even more money. This is not an option, but for evaluation purposes, it is feasible because we only need a limited set of applicants, and then we can do all model selection decisions based on evaluating on that sample. If this is not feasible, what we can try to do is we can adjust evaluation framework somehow to incorporate rejected applicants into the evaluation framework. The issue is that the labels of rejects are unknown, but we can find a way to still use rejects. And what we have been working on is a Bayesian evaluation framework that basically uses both accepts and rejects in the validation set, then evaluating performance of the scoring model. So basically we include accepts with the true labels and then also append rejects with pseudo labels, and we randomly assign these pseudo labels based on the prior probability of being bad, which comes out of the predictions of the current scoring model. So we know this model is biased and it will produce bad predictions to some extent, but we also introduce the random component, hoping that it would take care of that a little bit. And then we see from the experimental results that gains from having rejects there, even with noisy labels that come from imperf prior, still helps to get a more reliable estimate compared to not including rejects in the validation sample and only evaluating on a validation set of accepts. And to give you a rough understanding of the extent with which these methods can help, This is the same plot that you saw on a couple of slides ago, but incorporating the improvements from our proposition. So with self-learning and labeling rejects and augmenting the training data, we are able to train a better scoring model that recovers some of the loss due to bias that we observe here. And with the Bayesian evaluation framework, we are able to get a more reliable estimate of the model performance. It is still far from being perfect, but it is better compared to the accepts-based training or evaluation. Right, and now let me maybe also say a few words about some further challenges that further complicate the sampling bias problem and remain even after we try to mitigate the sampling bias. So first of all, the problem of sampling bias between accepts and rejects is amplified by other sources of sampling bias, such as covariate shift and concept shift, which is in general known as dataset shift. So what happens is that due to external changes like business cycles, pandemics, or maybe some internal changes in the company, like changes in the acceptance policy or marketing strategy, we see shift in the distribution of applicants which come for us asking for a loan. And this is also complicated by the fact that there is a long delay between the time when we issue a loan and the time when we actually learn whether a person paid back or not. So this amplifies the sampling bias problem and can also make things worse and may require some separate attention and other techniques to be able to fix the losses from that kind of bias that occurs with dataset shift. And another issue is that sampling bias actually depends on many other factors, like what is the classifier that is used by our company? Because, for example, if we use a parametric model such as logistic regression, it is able to extrapolate outside of the future range that we observed in the training data. Like if we observe a person with income twice as high as the previous maximum in the training data, then our model can just multiply that income by a coefficient which is estimated, right, and get an adjusted prediction. But if we have a tree-based model like random forest or gradient boosting, they're not really able to extrapolate, and they will output the same prediction regardless of whether the income now grows 5x or 10x compared to the previous maximum. This is also a problem. And this is not to mention the regulation-related challenges that may prohibit you from actually using the data on the previously rejected applicants, because you are required to delete this data after a certain period of time. And there are many other challenges that I didn't have time to list here, but that can also lead to amplifying the magnitude of sampling bias or masking the potential gains that you can gain from bias correction methods. I think this is it in terms of the talk. Thank you very much for your attention. On this slide, I have listed some of my contact information. If you wish to get in touch via email or LinkedIn, I'm happy to discuss this and other things. And also, if you are interested in the slides of the talk, you can use this QR code to open the link to the that has slides as a PDF file. Thank you, and I'm happy to hear any questions you might have.